Our classroom stock portfolio of high-yield dividend-paying companies now has an annual return of 32.4%. Its performance actually went up this week, even though the S&P 500 fell. And our dividend growth stock portfolio now has an annual return of 18.65%. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,180.85 after 133 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting 2.5 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or a list of our best performers, or any other section of the video. In 2022, the year we started the dividend growth portfolio, the market did not perform well, but because I do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,180. The portfolio's return has been 18.65% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. This slide shows how the dividends in our dividend growth stock portfolio are growing. The graph shows the cumulative dividends we've received so far. Our dividends this quarter increased 51% over last quarter, and our dividends this month increased 87% over last month's dividends. In this video, we talk a lot about our dividend growth portfolio and our newer high-yield stock portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high-yield portfolio was started in August of 2023, and the annualized return so far is 32.4%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 22.54% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high-yield has zero tech stocks, but time will tell. Well, it has zero tech stocks so far. Of course, this tech stock pullback this week definitely helped our high-yield stock portfolio. Now remember, the high-yield portfolio has only existed for a bit less than 12 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio, as we definitely saw this week with another large jump in total return. So why do we only invest in dividend-paying stocks for these portfolios? The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of this screenshot. Morningstar also recently released a report that went all the way back to 1927, so it's a longer study, and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios only invest in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces, one, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payment to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, which is a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 8.13%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in that portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to yields on costs that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. This is perfect for retirees. If you are single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate in income from qualified dividends that would be federally tax-free. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, When I was only making $11,000 per year as an enlisted member of the military before I got my college degree, I started my investing journey with only $25 per paycheck. In other words, equivalent of $12.50 per week. And because my brokerage account now, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into these portfolios, but found the process to be so fun that I split it up and now invest $12.50 every week, and we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is about the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. For Classroom stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. And in year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. Now, SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our Classroom stock portfolios. As of today, our Classroom stock portfolio's annual return, and this is for the Dividend-Growth portfolio, 18.65%. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 9.87% per year, a difference of 8.8% per year. Our Hi-Yld portfolio is also outperforming SCHD. Now, obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in the same stocks in our Classroom stock portfolio and our Hi-Yld portfolio. I also prefer our actively managed Classroom stock portfolio strategies rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps. Now, this slide shows our best performing stocks in our Dividend-Growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, moves to the top spot with a total return of 196.5% in less than 2 years. As you will see when we get to our slide on dividend increases, our investment banks have been doing great. Stocks in yellow on this slide have been sold. And remember, the total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they're usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week. Despite the market pulling back this week and large cap stocks getting wrecked, we had a slew of good performers this week, so I split the graph into two sides. On the left, under the green bracket, are our best performing dividend growers this week, led by United Health's 10.6% gain. On the right side, under the purple bracket, we have our under the radar dividend paying companies that performed the best this week, led by Nicollet Bankshares with a 12% gain. And as you might know, the small cap stocks have done really great over the last 5 trading days. I believe they are up total of 12% for small cap stocks in general. Here is a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. Now on to stocks we purchased this week. 90% of our stocks in the dividend growth portfolio are comprised of high quality dividend growth stocks, but the other 10% or so is invested in under the radar dividend paying companies. These are usually smaller and tend to be a lot riskier. This week on Friday we purchased Atmos Filtration Technologies, an under-the-radar dividend payer that recently initiated a dividend and a stock buyback program. Atmos designs, manufactures, and sells filtration products under the FleetGuard brand name globally. The company offers fuel filters, lube filters, air filters, crankcase ventilation, hydraulic filters, coolants, and fuel additives, as well as other chemicals. And this is the exact type of dividend stock that appears to be boring, but in the long term often turns out to be a great performer. Now we don't sell stocks often, but this week we did make some sales. We sold two, in fact, because better opportunities became apparent. First, we sold Bank of America for a total return of 62.7% in 15 months because it appears to be fairly valued. And the stock that replaced it, PNC, which is a smaller bank, appears to have much greater upside. And to buy Atmos, which we showed on the previous slide, which is the under-the-radar dividend payer, we sold Paycom, which is also an under-the-radar dividend payer. We held Paycom for a bit over a year and has been our portfolio's worst performer. As I mentioned on the previous slides, we bought PNC, a bank, to replace Bank of America, and Atmos Technologies, an industrial stock, on Thursday and Friday, respectively. Atmos replaced Paycom. But back on Monday, this slide is showing the 10 stocks we bought for our dividend growth stock portfolio. We bought W.R. Berkley, Thermo Fisher, MasterCard, Visa, Nike, Masco, Northrop, Interpublic, Cigna, and Papa John's. The two stocks in yellow, Comcast and Allegiant, we did not buy because they now comprise more than 4% of our portfolio. Brand new to the portfolio is W.R. Berkley, an insurance company that often pays a special dividend. If you ignore the special dividends, its dividend yield is 0.6%. But in the last 12 months, it paid 3 special dividends, giving a 2.43% yield based on the last 12 months. So remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be W.R. Berkley, Comcast, Nike, and Papa John's. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields are, in order, Interpublic, Papa John's, and Comcast. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% or so of our purchases are invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown these historically beat the market averages by a significant amount. Other than Atmos Technologies, which we mentioned on a previous slide, all the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising their dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And remember, earnings is just another word for profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest starting with Nike. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Thermo Fisher, MasterCard, and Visa. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and higher yield are Comcast, Nike, and Interpublic. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are W.R. Berkley, Thermo Fisher, and MasterCard. The companies with the best combination of recent dividend increases and potential of future dividend increases are W.R. Berkley, Comcast, Thermo Fisher, MasterCard, and Visa. On this slide, we're looking at stocks in our portfolio that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. This week, we had 5 stocks raising their dividends. Leading the way were 3 of our investment banks. Morgan Stanley raised its dividend 8.8%. In the last 5 quarters, the bank has increased its dividend a total of 19.4%. Goldman Sachs, another investment bank, raised its dividend 9.1%. In its last 5 quarters, the bank has increased its dividend a total of 20%. Yet another investment bank, Bank of New York Mellon, raised its dividend 11.9%. In its last 5 quarters, the bank has increased its dividend a total of 27%. And ASML, a leading chip equipment manufacturer, raised its variable dividend for the 3rd consecutive quarter, this time by 15.1%. Over the last 3 quarters, ASML has increased its dividend 22.1%. Now, the last 17 dividend increases for the portfolio have an average of 17.1%, well above inflation. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once a stock split has occurred. And here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Sunday. Comcast has moved to the top, followed by Allegiant, then American Express. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst times possible. Our portfolio holdings are now at 95. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies, even though it's humongous, makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. Now, I've had several older students who are closer to retirement take my classes. They are more interested in stocks with a higher dividend yield and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annualized total return so far of 32.4%. Since the portfolio has been in existence for less than a year, that return will likely fluctuate a lot. And of course, we don't think it's going to stay at 32.4% since stocks historically average 9 to 10% a year. Currently, the portfolio's dividend yield is 4.35%, but the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolios have increased their dividends already, pushing the portfolio's yield based on the amount we have invested to 5%. Now, two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth, and so far has been the better performer. The average investment in this strategy has provided a total return of 15.29%, and has been held for an average of 156 days so far, which is an annualized rate of 39.4% using Excel's rate function. Now, like I said before, it's not likely that we can keep up this high of a return, but so far, so good. On this slide, we're looking at the high yield dividend paying stocks we bought this week. One thing that's different about this strategy, this higher yield strategy versus our dividend growth strategy on previous slides, is we only purchase 8 stocks in this high yield dividend paying portfolio. And as I mentioned, we have 2 different strategies. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, which happens often, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. And the 4 high yield stocks we bought this week while implementing strategy 1 are Devon Energy, Interpublic, Chevron, and Darden Restaurants. And the 4 high yield stocks we bought this week while implementing strategy 2 are Interpublic, Papa John's, Chevron, and WEC Energy. This week's purchases have an average yield of 4.5%, with Devon Energy coming in the highest with a 6% dividend yield. And here's a look at our ratings for competitive advantages, management, and financial health. And finally, on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So that's it for this week. In the comments, let me know if you have any questions. Here are the places you can reach me: Twitter, LinkedIn, beatthestockmarket.com, my website, and of course on YouTube. Talk to you next week.